As we move into 2026, investors are facing one of the most important asset allocation questions in years. Should you favor bonds or stocks? After a period of high inflation, aggressive interest rate changes, and market volatility, the investment landscape looks very different from what it did just a few years ago. In this video, we'll explore how bonds and stocks compare in 2026 and where smart money is positioning itself. To understand this debate, we need to look at the broader economic backdrop. Inflation has moderated compared to its peak, but interest rates remain relatively elevated. Central banks are walking a fine line between controlling inflation and supporting economic growth. This environment has reshaped expectations for both stocks and bonds. For much of the past decade, stocks clearly dominated bonds. Low interest rates made bonds unattractive, while cheap money fueled strong equity returns. But in 2026, that dynamic has changed. Bonds now offer yields that investors haven't seen in years, making them a serious competitor to stocks for the first time in a long time. Bonds are regaining attention as a source of income and stability. Higher yields mean investors can earn reasonable returns without taking excessive risk. For conservative investors, retirees, and institutions focused on capital preservation, bonds are once again playing a meaningful role in portfolios. However, not all bonds are equally attractive. Short and intermediate term bonds are often favored because they balance yield with lower sensitivity to interest rate changes. Inflation-protected securities are also gaining interest as investors look for ways to protect purchasing power in an uncertain inflation environment. Stocks, on the other hand, continue to offer long-term growth potential. While volatility remains, equities benefit from innovation, productivity gains, and earnings growth over time. In 2026, smart equity investors are being more selective, focusing on quality rather than broad market speculation. High-quality companies with strong balance sheets, consistent cash flow, and pricing power are attracting the most capital. Another key difference in 2026 is diversification. Instead of choosing between bonds or stocks, many investors are blending the two more thoughtfully. In conclusion, the bonds versus stocks debate in 2026 reflects a more mature and disciplined investment environment. Bonds are no longer ignored, and stocks are no longer blindly chased. Investors who understand the strengths and risks of both asset classes are better positioned for long-term success.